Andrew Marder from Capterra here, and today we're going to be talking about double entry accounting, what it is, why you should have it, and where you can get it. So before we get into anything, as I always say, talk to your accountant. If you're interested in any of this stuff, or if you're worried that you're doing it wrong, get an accountant, talk to an accountant. We'll talk about that a little bit at the end. So double entry accounting is a step forward in accounting from your checkbook. So classically, accounting is just cash-based. Not classically. Double entry accounting has been around for 500, 600 years, something like that. Traditionally, for the consumer, I should say, accounting has basically been done in the checkbook. I have $100. I put in a decrease of $50 because I buy an expensive lasagna, and then my checkbook looks like $100 minus 50. The remaining balance is 50. All right. So what I see in this is how much cash I have at any given point in time. What I don't see is what happened to that $50 in any meaningful way. And what happened is it turned into a physical asset, right? So now I have $50 worth of lasagna. Please don't purchase a $50 lasagna. So to capture that, you need some sort of non-cash-based accounting method, and that's what double entry is. So double entry accounting works on the basis that there's a matching principle in place which says that every entry that you make should be mirrored by one or two, at least one other entry. So you should have two at a minimum entries into your accounting system for every purchase, transaction, shift in inventory that you have. And then on top of that, it's based on this premise that the assets of your business should always be equal to the liabilities of your business plus the equity that your business has. So what that means is anytime I make a purchase, anytime I do anything, making a purchase is going to be the most common one for most small businesses. But anytime I do anything like that, I need to make two entries because I need to say, oh, I lost some cash, but in return, I got some machines, or I got a van, for instance. And so you're going to put two entries into your system. Now, a lot of current accounting software packages will guide you through this in a way that's much more intuitive than classic double entry accounting is. We're going to talk about that today, about the classic side of this, but know that if you're looking for accounting software and you swing by capterra.com, you can find stuff that will basically hide all the double entry stuff from you and make it a lot more easy on the eyes, certainly. But you'll still get all the benefits out the back of it. Anyways, so with double entry, everything that you do in your business is going to have an associated account type. And so when you start a double entry system, you start with a chart of accounts, which is basically like, here's everything that I could have any value in my business in. So you've got wages, you've got machines, you've got rent, you've got cash, you've got debt you owe people, you've got owner's equity, you've got anything. If there's something that your business could have, you can make an account for it in your chart of accounts. Now you can make it as simple or as confusing as you'd like. Confusing is the wrong word. You can make it as simple or as complex as you'd like it to be. The more complex it is, the more granularity you'll have when you go to do some of your financial reporting, for instance. The simpler it is, the easier it is to whip these things into different categories. It's up to you, in large part. Again, talk to your accountant. So once you have all these systems set up, you're going to have some classes of these are going to be asset accounts, and some are going to be liability accounts. Now, it's not the trickiest part, but one of the trickiest parts of double entry accounting is that it uses the term debit and credit in a very different way than we classically use it. So when I say to you that you need to issue a debit, or that you should debit that account, what you usually think is taking money out, right? When you credit it, you add money. When you debit it, you take money out. In double entry accounting, that's not the case. In double entry accounting, if it's an asset account and you debit it, then you add money to it. Whereas if you credit it, you take money out. And the reason for this confusion is that the terms debit and credit are bank terms. And so if I'm a bank and I have money in your account, that's a liability for my side. So if you take out $500 from your account, you're basically crediting me because I no longer owe you that $500, right? So suddenly you're crediting the bank because the bank doesn't owe you that money anymore. They don't have it to play with, but they also don't owe it back to you. It's not a liability on their books. And so they treat it as a credit. Whereas when you put money in, it's a debit, right? Because it's more money that they owe you. And so this is all drawn up originally from the banker's point of view. Now we've picked it up as common parlance. We just use the terms debit and credit, and we use them in a different way because we use them from our perspective. But historically, that's where they came from. That gets confusing. So for instance, you're buying that van. Say you've got two accounts that you're going to be playing with when you buy the van. You've got a cash account, right? But you've got to match that up with something. You're losing $25,000 in cash. You got to get something for it. And what you're going to get is equipment. You might have, there are other ways that you could do this to make this more granular, to get a better view of where that cash actually goes, but equipment is fine for us right now. In this example, you're going to credit your cash account $25,000 because cash is an asset. And so when you take money out of your asset account, you use a credit entry. And so the credit of $25,000 means that you're actually showing a decrease in the amount of cash that you have available. It sounds weird, you're crediting the account, the money's going down. It's like learning to ride a bike backwards, which is fascinating, and there's a YouTube you should search here, up there. You should go find it, but a guy tries to ride a bike backwards. Not backwards, but the handlebars make it steer the wrong way. Anyways, fascinating. That's the basic idea. Once you sort that out, once you can get over that little hump, then you'll be set for life. But anyways, so you've credited, which means you've taken money out of that cash account. Now you've got to put it into something. There has to be a matching increase in value somewhere. And that's going to be in your equipment account because you're giving someone $25,000 and they're giving you $25,000 worth of car. And so that $25,000 worth of car is going to go into your equipment account as a debit because equipment is also an asset class. And so if you're adding money to your asset accounts, you're going to make a debit entry, right? So you put that equipment, $25,000 debit, goes in the equipment account, that increases the value of the equipment account. Now it all balances out. You've taken $25,000 out of one account, and you've put $25,000 in another account. The beauty of this, and this is why you should care about double entry accounting at all, the beauty of this is that now you know where the money is and how it's moving through your business. Instead of this checkbook system, where you know that you spent $50 but you don't know really what it was on, or you have a huge list of just stuff that you bought with an associated entry, but you don't know what it's been transformed into, you don't know how it's moved around within your business. You lose all of that when you just do cash accounting. When you move beyond cash accounting into double entry accounting, you get that granularity, you get that view of your business that says, here's where I spent the money, here's where the money that I have left is, and here's how much equity I have in the business. You can easily generate this. You can find out how much equity is in the business. You can find out what your liabilities are. You can therefore know exactly what your assets are. You can also go through and you can do all the basic income and balance sheet statements that you're going to do when you want to do some reporting or if you're looking to get another loan for your business. You won't be able to do consolidated cash flow. That's at least not from the shortened version of this that you'll get. So the beauty of double entry is that it spits out at the end of any reporting period. You can spit out a very simplified breakdown of all the accounts that you've done. It's called a trial balance, and we'll talk about that later. Not in this video, another one. But once you get your trial balance, you can generate all these reports off the back of it and very quickly know how your business is doing, how much money you're spending, where that money is going, and what you can do to improve your business. Now, to get the real view of this that you're going to want to get, don't go into Excel. I love Excel. It's fantastic. Don't use it for this. It's super complicated. Small errors can be big errors further down the line. Get yourself some accounting software. There are free versions out there if you don't want to spend any money. There are cheap versions out there if you want to spend a little, or you can spend a fortune and tie it into an ERP system or whatever you want to do. But get yourself some accounting software and get yourself an accountant. Step one, I would say, accountant. That person is going to be able to give you their view of what the most important software out there is, what pieces you need and features you need. They'll hook you up. They'll find something that manages double entry, or they'll tell you that you're a freelance graphic designer and it doesn't matter, you don't need double entry. But if you own a business with assets, if you're making purchases on any sort of scale, having that double entry accounting is just a for sure thing to do. There's no reason not to do it. The level of complexity it adds to your business is very small, but the level of insight that you get is huge. For more insights on your business and your finances, please visit Capterra's blog. You can also like, subscribe, leave a comment below if there's more stuff that you'd like to hear us talk about, and we will see you soon. Thanks very much.